Welcome to the Money Runner. I'm David Nelson. This is a Thinking Out Loud podcast as we head into the week on the heels of a punishing start to the second quarter. There are several catalysts to the recent sell-off of risk assets over the last couple of weeks. The potential for conflicts in the Middle East to accelerate are, of course, a major concern. Will it spin out of control? What does it mean for oil prices? And in turn, could it trigger a global recession? While the above is serious, the bigger threat to equities is rising interest rates. The hot CPI and PPI reports earlier in the month have triggered speculation that the Fed may not cut this year. Recent comments from Fed Chair Jay Powell confirm the Fed does not believe they have the data yet to support an easing of monetary policy. While higher for longer is a challenge for equity prices, stocks had held up well under the threat of cuts being pushed out further. So what changed? Elevated rates are a challenge, but rising rates, that's kryptonite for equity prices. Just recently, former Secretary of the Treasury Larry said that rate hikes, you heard me right, rate hikes are back on the table. Look, Larry's comments shouldn't be ignored. He's one of the few economists that got it right, predicting that inflation could get ugly as far back as the first quarter of 2021. Valuation models start and end with the risk-free rate. When it's a moving target, it becomes nearly impossible to judge just how much we should be paying for our favorite stocks. We've seen this a couple of times in the last 5 years. Performance over the last couple of weeks is eerily similar to 2018. Back then, 10-year yields were crossing above 3%. That was a line in the sand for institutional investors. I remember being at a FactSet conference back then, and I went up to some institutional investors, including insurance companies, pension plans, and the head of one endowment. I asked them, what's going on? What are you guys doing right now? And they said, we're done with stocks. We just don't need them right now. We can match liabilities with another asset class, a safer asset class. And for them back then, with rates at 3% on the 10-year U.S. Treasury, they could go to corporate bonds, which were paying 100 basis points higher, 4%. That was enough for them. It's the same thing today, but with 10-year rates on a path to 5%, they have even more of an incentive. Each stair-step higher in rates forces these very large asset allocators to shift capital out of stocks and into fixed income. In the last 3 weeks, investors have been forced to go back to their 2022 playbook. With rates rising, money shifts from growth to value. Momentum as a factor takes a backseat to free cash flow and dividends. Sometimes we make it too complicated. Here it is in one sentence. When rates stop going up, stocks will stop going down. Okay, let's take a moment and discuss some of the warning signs we got last week from inside the semiconductor industry. Remember, they're on the front lines and often the first to give us the bad news. ASML Holdings, an important semiconductor equipment manufacturing company based in the Netherlands, talked about soft billings in their most recent conference call. It could be something as simple as some customers holding out for better prices, but for now, that commentary set the stage for a large sell-off in semiconductor stocks that have been the biggest beneficiary of AI-related themes. Taiwan Semiconductor, maybe the most important wafer manufacturing company in the world, added to the pain with commentary highlighting that while demand for AI applications remains strong, general server demand has been muted. Is it possible estimates have been pushed too far? Sure. This is an important reset in expectations that, when once complete, sets the stage for a more sustainable path higher. The factor that gives me the most pause is rates. Just how high will they go? And what, if anything, is the United States going to do to arrest this dramatic climb in debt and deficits? We talked about this last week. There is a concerted effort around the world to get off the dollar as the reserve currency. We can't tax our way out of this. Look, we can have a debate about who should be paying more or less taxes, but what isn't up for debate is that we are hitting levels of tax revenue versus GDP that will ultimately crowd out the real economy. If you got anything out of today's podcast, do us both a favor. Hit subscribe. And don't forget to sign up at my Substack site, dcnelson123 at substack.com. They're both free. Thanks for joining. I'm David Nelson, and this is The Money Runner.